All right, so I am on an 11-day win streak right now, and I do not think that is luck. I think that it directly attributes to a few different practices that I use, a few different strategies, a few different tips or tricks in psychology, and a very specific risk management plan. So what I'm going to do in this video today is I'm going to cover all of these different topics. I'm going to break down exactly what I look for in every single trade, what I'm targeting, where my stop losses go, where my take profit levels are. I'm going to tell you what my risk management plan is, and I'm also going to tell you how I went from having my worst trading week of the year to winning 11 straight days. All right, so let's get into it. I'm glad you're here. I hope you enjoy the video. If you do, I hope you leave a like, subscribe, comment, share this with any friends that might be interested. I think this is going to be a very, very good video with a lot of good info. So I hope you enjoy. So the first thing I want to talk to you about is how I went from having my worst trading week of the entire trading year to having almost 3 weeks straight of not losing a single day and being profitable and grossing over $40,000. Now, the dollar amount truly does not matter because everybody's on a different path. Everybody has different trading capital. So I don't want you to focus on that. I just want to use that as a reference just so you guys can kind of understand some of these ideas about risk management and things that I'm talking about. Okay, but the first thing I really want to get into is psychology. So after that losing week, I lost 4 days in a row. Didn't have one winning day. I was letting my emotions actually take control of me, which I almost never do. I was basically taking trades that were not there. I just was not there mentally, okay? I had some stuff going on in my personal life, and I was letting that affect my trading. And that's something I always teach not to do, right? So sometimes, you're going to go against your plan. Sometimes you're going to make mistakes. We're all only human. But what I had to do was have a complete shift in my mindset. I needed to change something. So what I decided to do was on the Friday and the Saturday after that trading week, I told my community, I said, guys, I will not be thinking about trading for the next 2 days. I'm going to go enjoy my time with my friends. I am not going to think about trading because it was just taking over all of my basically headspace, right? Everything was trading, trading, trading. It was all negative thoughts. So I had to get myself, kind of dig myself out of that negative headspace. So those 2 days, no trading, no charts, no learning, nothing like that, no videos. What I decided to do on Sunday was get back into my Sunday routine. So here's my Sunday routine, and this might actually help you if you don't have a good routine on the weekends or even a morning routine. But this is what I do every Sunday. I wake up, I make a coffee. I take a cold shower to kind of get my brain stimulated, to get awake. It's really good. There's some health benefits. I would look into that. But I also go and do my stretching. I do my meditating, and I do my reading all on Sunday mornings. After that, I go to the gym, I do cardio, and then I do sauna, right? So I'm kind of basically resetting all the wiring in my brain, getting my head back into a good space going into the next trading week. But when I was doing my meditating and reading on that Sunday, I kind of had a full, like something clicked. It was like a light bulb, right? It was like a light bulb turned on in my brain from the reading I was doing. And what I realized was that I was trying to force my hand into the market. I was not being an observer. I was not allowing the trade setups to show me what they wanted to do. Instead, I was trying to create trades that were actually not there. I was trying to take entries off of strategies that I never even use. So I came to that realization on that Sunday when I was doing my meditating and my reading. And I thought to myself, okay, so this week, here's what I'm going to do. I am going to be an observer of the market. I'm going to allow the trades to come to me. I always use the analogy of surfing. I love to skate. I love to surf. But this analogy is super cool. This is just something I like to say is, as a surfer, you're not going to create a wave in the ocean. No, the ocean is in full control. The ocean is the market. It is in full control. We do not have control over what the market's going to do or what the ocean is going to do. You wait for the wave to show up, and then you go catch that wave, right? You ride the wave on your board. And it's the same thing in trading. You cannot create trades. You cannot create or tell the market what to do. You don't control that. But what you can do, what you can control is when the market is going to show you the setup. You can wait. You can be patient. You can wait for the setup to show. Wait for the market to tell you exactly what it wants to do, and then you execute your trade. Then you take action, right? So that was a huge shift in my mindset that I had while I was doing that meditating and reading that allowed for me to then go on this win streak where I am seeing the market clearer than I have seen it in months. I am seeing every setup. I'm executing my trades. There's no hesitancy in taking my trades because you guys probably know the feeling that when you start to lose, you go on tilt, you start to be less confident in your trades because now you feel like they're not going to work out. I don't have that feeling whatsoever. Every trade I take, obviously it is a risk and we are always willing to lose every trade, but I have the confidence to pull the trigger on every single trade, knowing that I have done the research that I need to do, knowing that I have a very successful strategy, knowing that my head's in a good space, and knowing my risk for every single trade. All right, so if you've watched this far, now what we're going to do is we're going to dive into the charts, and I'm going to tell you some of the strategies I've used to catch some really, really good trades the past few weeks. I'm going to break down my strategy in the most simple way I can think of. So there's going to be 3 things that we think about for every single trade that we take. Number 1 is going to be draw on liquidity. Number 2 is going to be market structure. And number 3 is going to be an entry model. These are the only 3 things that I need to take a very solid A+ setup in the market. So why don't we go take a look at what these 3 things are in the charts. All right, so let's talk about liquidity. I want you to imagine it as this invisible pool that is filled with orders, right? So above swing highs and below swing lows, that's where most of our liquidity is resting. So just imagine right above this high right here. Just imagine with me real quick. See this high right here. Think about that high. Think about all of the buy stop orders that are resting above that level that people are in short, right? People are in short, they have their buy stops resting above. Well, this is technically buy side liquidity. What are the market makers or the algorithm trying to do? They're trying to grab liquidity. They're trying to basically liquidate your orders, the retail traders' orders, to steal their money and then allow or manipulate price to go in their direction. What we want to do is trade like we are the institution, like we are the market makers, right? So right here, we have buy side liquidity. Let's focus on this range right here. Notice right here, we come up and we sweep buy side liquidity. Okay, well, that doesn't mean anything, Trader Joe. How do I know where we're going to go after that? Well, once we sweep liquidity, look what happens. We have sell side liquidity underneath this swing low right here. Look at this low. Imagine the pool again. There's a bunch of orders in a swimming pool resting right below this level that the market makers are going to want to come right back for. Okay, so this is sell side liquidity because we have the sell stops resting beneath this level. And we even have more sell side down here. Look at this range right here. Notice how we have relative to equal lows. Notice how this low comes right next to it. This is generated liquidity. Every time price comes down and tests a level and does not sweep that level, we are just generating extra liquidity, extra orders, extra sell stop orders beneath this level. So what are the market makers or the algorithm trying to do? They're going to come right back for that liquidity at some point. Okay, so we see us coming down. Look what happens. We come down, we sweep that liquidity, and then we get a reversal in price right back up to, well, you guessed it, a new buy side liquidity level, right? At this swing high. Boom, we came up for that buy side liquidity level. So that is all I'm looking for. Every single trade, I need to make sure that there is a target of liquidity that price is trying to run and grab. I imagine myself as the market maker. Whenever I take a trade, I say, where is the most likely point of interest that, the algorithm or the market makers are trying to take price to? Well, if I have a bullish, let's just say I have a bullish bias for the day. Well, I'm expecting price to come down and grab a bunch of orders, generate a bunch of liquidity, right? Steal all that liquidity basically, and then get a strong reversal and then deliver back to the buy side. Okay? All price is doing every single day is going back and forth to liquidity levels. We're going to have stronger trend days where price is only moving up for buy side, we're only moving down for sell side, and then we're also going to have days where price is doing both. So what we have to do is we have to align it with our higher time frame analysis. Okay, so you can look here on the hourly. This is higher time frame. This is external sell side liquidity. External is weekly, daily, 4 hour, 1 hour. Any of those time frames is external liquidity. My internal liquidity is going to be our smaller ranges like the 15 minute, the 5 minute, the 1 minute. So notice how we come down here. we grab this external sell side liquidity right there. We sweep it. I'll zoom in. We sweep it, and then we get our reversal, and we get price delivering to buy side liquidity. We even had a bunch more. If we zoom out, look at all these buy side liquidity levels up here. All these swing highs, these are all levels of liquidity up here. Price is trying to target. The market is going for these levels specifically because that's where all the money's at. The money is all resting above these levels, as well as imbalances. If we look at the daily time frame, right, we can see on the daily time frame, we have this imbalance right here. It's a bearish imbalance. So price is always doing one of two things. It's running for liquidity, or it is targeting an imbalance. So if you don't know what a fair value gap is, if you are still confused about what liquidity is, I have videos on both of these things for free on my YouTube. So I will link those videos for you in the description so you can get a better understanding of exactly what I'm talking about. But just to break it down one more time, in my strategy, I start with the weekly, the daily, the 4-hour, the 1-hour time frame. I'm breaking down my higher time frames. I'm trying to figure out where's our most likely draw on liquidity for the day, for the week, for the session, whether that's New York AM session or PM or London or Asia, it doesn't matter. Where's our most likely external draw? Then I'm dropping down into the lower time frames like the 15-minute, and I'm finding where is my internal draw, where are we going to go grab liquidity, and where are we going to reverse, or are we going to get a continuation? What levels can we use to take a trade from internal to external? So that is the first step of my strategy. The next thing we're going to talk about is how to use market structure in alignment with liquidity. Okay, we just talked about liquidity. Now we're going to talk about market structure. The first thing we want to look at, top left, bullish market structure. Higher highs, higher low, higher high, higher low, higher high. Second one, top right, bearish market structure. Lower low, lower high, lower low, lower high, lower low. Bottom left, bullish reversal pattern. We are in a bearish trend, and then we come down, we sweep sell side liquidity, and we get a market structure shift back to the upside, expecting price to now be bullish. And then vice versa for a bearish reversal pattern. Price is looking bullish, we're coming up, and then we come up, sweep buy side, and then we get price delivery down to sell side, and we get a market structure shift. Okay, so those are four of the main market structure patterns you want to pay attention to. I'm never going to fight against the trend. If the trend is bullish, I am looking for bullish trends. If the trend is bearish, I'm looking for bearish trades. So I meant to say bullish trades, not trends. Okay, if I see a reversal pattern, a few of the models that I like to use are breaker blocks and unicorns for these reversal patterns. This right here would technically be something like a breaker block. And if you want to kind of look more at what a breaker or unicorn is, I will link in the description those two videos that I have made about those models. Two of my favorite models I will ever use are the breaker model and the unicorn. They go hand in hand. They're almost the same exact thing, just one little difference. So again, market structure is the second step to my strategy. I will always make sure my market structure is aligning from my higher time frames all the way down to my lower time frames, just like we talked about when I was talking about liquidity, right? I'm going all the way from the weekly to the 1 minute time frame down the line, and I'm making sure that my time frames are aligning with market structure. I am not trading against a trend. I'm not trying to guess the top of a trend or guess the bottom of a trend. I simply wait for the reversal, or I wait for the continuation of a trend. I wait for the pullback. I'm an observer of the market. I allow the market to tell me exactly what it wants to do, and then I jump into my trades. So remember to study your market structure. Okay, so now we're getting into the good stuff right here. These are my favorite entry models. Remember, we have 3 steps here. We need to have a target liquidity, we need to have good market structure, and now we need to have an entry model that's going to allow us to take a trade aligning with our market structure that's going to take us up to that liquidity or down to that liquidity. So my first entry model that I like to use are breaker blocks. These are reversal patterns. I kind of talked about a breaker block just earlier when we were talking about market structure. The next is unicorn model. It's the same thing as a breaker, but it's when a fair value gap overlaps the breaker block. Unicorn model is my favorite entry model of all of them. It's probably the one that I use the most consistently. The next one is silver bullet. This is an hour in the day when we see price typically running for a key liquidity level. So that's the first hour is from 10 to 11 a.m. Eastern. The second is from 2 to 3 p.m. Eastern. These are my favorite times of the day to trade because we are typically offered some pretty good price action. And I'm usually using 1 minute, 2 minute, 3 minute, 4 minute, and 5 minute fair value gaps as my entries. The next one's turtle soup. This is somewhat similar to Silver Bullet, but this is where you're looking for an internal liquidity sweep that is now targeting external liquidity. I really like this one as well. The next is London Close Reversal. I don't know if you can really classify this as a real entry model, but it's something that happens where time and price usually align. So what happens is London market closes at 11:30 a.m. Eastern time. So what we like to see is, let's say we are in a good trend day. Typically what I'll do is I'll use the Fibonacci retracement tool. I'll go from the low of the day to the high of the day. Let's say we're bullish, and I want to see price come back during lunch hour to the discount or below the 50% of that range. So that's something that I also have a video on that you can go check out on my YouTube as well. Next one is just the 2022 model as a whole. This is a very, very good model, and I always recommend to people that are beginning their journey in ICT to go watch the 2022 mentorship, super beneficial. And then the last one is inverse fair value gaps. This is the last little key to my strategy that has allowed me to be so consistent. When I align these inverse fair value gap entries with my market structure, with target liquidity, with these other entry models, it's almost unstoppable. Okay, so these are my favorite entry models that I definitely recommend you go check out. I have videos on pretty much all of these. The only thing I don't have a video on right now is the inverse fair value gaps, but I will be making a video on that in the future. Let's talk a little bit about risk management. This is the last step to my overall strategy that might be the most important step of all of them. Most beginner traders have no risk management plan whatsoever. So that means they're probably over leveraging or they're over trading. If you don't have a plan, how are you ever going to find discipline and consistency in this market? So let me just tell you a little bit about my plan that I do every single day, no matter what. So the first thing I do is I only risk 1 to 3% of my account per day. So whether that's in one trade or whether that's in 2 to 3 trades, it doesn't matter as long as I'm only risking that per day. So I usually, on every single trade, I like to at least have a 1 to 2 risk to reward and more. So I don't like 1-to-1s unless my win rate is crazy. The only time I will do 1-to-1 risk to reward is if I am winning maybe 80% of my trades. If I'm not winning 80% of my trades, I'm looking to have at least a 1-to-2, 1-to-3, 1-to-4 RR or risk to reward. Okay, my other rule is that I only take about 2 to 3 trades per day. Sometimes it's 1, sometimes it's 2, sometimes it's 3. It depends on the day. The only time I'll ever take more than 3 trades is if I still have some room to trade in my account and I still see an amazing setup. Let's say I'm only down maybe 0.05% of my account risk on that day and I see a really good setup. Well, then I might take a 4th trade after that. That's the only time I'll break that rule. The next rule, the last 2 rules are super important, maybe the most important of all. When I hit my loss limit, I walk away, I stop trading. There's no more trading for me. I'm done. And the same thing as when I hit my profit target, I'm done. So let's just say, for example, my profit target is $500 on the day. When I hit $500, I walk away, I close my computer, no more trading. Let's say my loss limit is $250. When I hit my loss limit, $250, I stop trading, because if you can stick to these rules, you're going to be able to start building discipline and maybe fighting against that urge or that really bad habit of over trading, of revenge trading, trying to make your losses back, or getting greedy when you're in the green and then getting back to break even. So no matter what, every single day, I stick to these rules, and that has allowed me to be very, very successful and very, very consistent in my trading.